Usually when you're, dealing with a medical diagnosis, there's this fundamental expectation of precision.
Right, it's very clinical.
Exactly. It's an engineering problem at its core. Like, you break your arm, the x-ray shows this jagged white line across the bone, and the doctor just points to the film and says, well, there's the fracture.
Objective reality.
Purely objective. But when you step into the world of investing, specifically when you're trying to diagnose the financial health and the actual sustainable profitability of this whole artificial intelligence boom, that x-ray machine is essentially broken.
Oh, completely broken.
We are looking at a diagnostic landscape that is just entirely opaque. You've got, every single company in the market screaming about their AI integration.
Yeah, throwing the buzzword around on every single slide of their pitch deck.
Right. But trying to figure out who is actually capturing real sustainable cash flow from this huge architectural shift is, it's a completely different challenge.
It is the absolute definition of diagnostic muddy waters. The broader market right now is just completely hypnotized by the prospector.
By the prospectors, yeah.
You've got retail and institutional money just relentlessly chasing the companies designing the underlying chips, right? Yeah. Or the software as a service providers promising to revolutionize everything with generative AI.
Sure, which are important.
They are. They're obviously critical to the ecosystem. But they are all fighting in a very crowded, incredibly expensive, and frankly, highly speculative arena.
Yeah. The capital expenditure required just to stay relevant in that silicon design race or the foundation model race is staggering.
It's unbelievable.
And the risk profile there is, it's existential. If you're designing AI chips and your architecture is, just one step behind the competition for a single generation, your market share just evaporates.
Gone. Poof.
Which is why if you want to find sustainable, de-risked cash flow in the sector, you really need to abandon that prospector mentality.
Right. Stop looking for the gold and look for the pick and shovels.
Exactly. We need to look at the vascular system of this entire technological shift. The AI models are the brain. The GPUs are the muscle, but, none of it functions without the vascular system.
The physical reality of it.
The physical cooling, the massive power delivery networks, the fiber optic nervous system that actually connects tens of thousands of processors.
Yeah, it all has to physically exist somewhere.
It does. And that brings us to today's mission. We are diving into the Q3 2026 earnings call for Jabil Inc. Ticker symbol is JBL.
And look, if you have historically viewed Jabil as just a legacy contract manufacturer, bending metal and assembling generic consumer electronics.
Which a lot of people do.
They do. But the data they're putting out right now demands a complete recalibration of that thesis.
It really does. As a retail investor, sifting through these corporate earnings calls can be tedious and overwhelming, but we are here to cut through the noise. In under 5 minutes, we are going to extract the headline numbers, uncover the true story driving those results, translate management's guidance, and give you an actionable, highly opinionated bottom line on what to do with the stock.
I love it. Because the transformation reflected in these Q3 numbers is just profound.
It really is.
Jabil is rapidly proving to be the critical physical bottleneck through which this entire AI boom has to pass.
The physical bottleneck, yes.
We're analyzing their financial results today, not just to, diagnose the health of one company. This transcript serves as a real-time stress test for the physical limits of the global AI build-out.
Right, because when you look at what Jabil is manufacturing right now, advanced cooling systems, high-density servers, modular power distribution, you're looking at the physical ceiling of what is currently possible in a modern data center. So let's get straight into it. Part one, the headline numbers. Because they came in incredibly hot and they tell a story of severe operational leverage.
Very severe.
For the third quarter of fiscal 2026, Jabil reported top-line revenue of $8.8 billion.
Wow.
Yeah, that represents a 12% increase year over year. But, context is everything here. That $8.8 billion beat the midpoint of their own internal outlook by a massive $250 million.
That is wild.
They essentially found $250 million in unexpected upside revenue in a 90-day window.
Which is an impressive top-line beat, obviously. Yep. But in the manufacturing sector, revenue growth without margin discipline is often a massive red flag.
Right, because you can just buy the growth.
Exactly. A lot of legacy manufacturers can artificially buy revenue growth by just slashing their pricing to move volume.
Sure.
Which temporarily boosts the top line, but completely destroys their operating margins.
And Jabil didn't do that.
No, Jabil executed an exact opposite strategy this quarter. If you look at their profitability metrics, their GAAP diluted earnings per share came in at 2.59. But their core diluted earnings per share, which strips out all that one-time accounting noise and gives you a much clearer picture of underlying operational health.
Right, the number we actually care about.
Exactly. That hit 3.16. That is a massive 24% jump year over year.
Okay, so pause right there. A 12% revenue growth translating into a 24% expansion in core EPS. I mean, does that just mean they are aggressively cutting costs, or is there a fundamental shift in what they're actually selling?
It's the latter. It is the holy grail of heavy industry. It is pure operating leverage.
Okay.
They are not achieving that by aggressively firing staff or arbitrarily shutting down capacity to squeeze out some temporary profit. The numbers show a fundamental shift in the composition of what they are selling.
So they're moving away from the cheap stuff.
Exactly. They are moving their entire manufacturing floor away from commoditized low-margin assembly and toward highly complex, high-value engineering.
Okay, and let's translate the margin jargon for a second, because we can see the mechanical reality of that shift in their core operating margin, which expanded to 5.8%.
Yes, driven by a core operating income of $504 million.
Now, if you are used to analyzing software as a service companies, a 5.8% operating margin might sound microscopic.
Right, software margins are usually like 70 or 80%.
Yeah, but you have to contextualize this within the reality of global contract manufacturing. I mean, Jabil is managing millions of square feet of physical factory space.
And navigating incredibly complex global supply chains across multiple continents.
Exactly, and employing tens of thousands of physical workers. So in that environment, plain and simple, a 5.8% core operating margin is exceptionally healthy.
Very healthy. And more importantly, it's the trajectory that matters.
Right.
The margin is expanding because they are actually making more profit on every single incremental dollar of product that rolls off their lines.
Okay, so that brings us to part two, the story behind the numbers. What is the engine actually driving that margin expansion?
Well, the absolute center of gravity for this entire earnings report is their intelligent infrastructure segment.
This is the AI engine.
Yes. This is the division where Jabil houses all their AI-related business. That encompasses capital equipment, cloud and data center infrastructure, and advanced networking.
And the velocity of the growth here is just jarring. This segment exploded by 21% year over year, hitting $4.2 billion in a single quarter.
To understand how they're generating that volume, you really have to look at the subcomponents of that segment.
Okay, break that down.
So Greg Hebert, Jabil's CFO, he noted that capital equipment and cloud infrastructure both grew by double digits. But the most revealing metric he shared was that their networking and communications business was up more than 50% year over year.
50%?
Yeah. A 50% ramp in networking hardware for a company of this massive scale is an absolute anomaly. It points directly to the architectural demands of artificial intelligence.
Right, because an AI data center is fundamentally different from a traditional cloud data center.
Completely.
You're not just sliding a few independent servers into a rack so they can serve up web pages.
No.
You are clustering tens of thousands of high-performance GPUs together to train a single foundational model. And every single one of those chips needs to talk to the others instantaneously, continuously, without bottlenecks.
The bandwidth required is literally tearing traditional networking infrastructure apart.
Exactly. The physical limitations of legacy networking are breaking under the strain of AI compute.
Yeah. Mike Dastor, the CEO, he specifically highlighted the surging demand for InfiniBand and high-speed Ethernet switchgear, and also a massive ramp in silicon photonics.
Silicon photonics, this is where the engineering gets incredibly complex, right?
Yes, and where Jabil's margin expansion originates. Think about traditional data center networking. It relies on copper wiring to transmit electrical signals.
Right. Normal Ethernet cables, basically.
Exactly. But when you push the massive amount of data required by modern AI clusters through copper at those speeds, you run into two insurmountable physics problems.
Heat and signal degradation.
You got it. Copper physically cannot move the data fast enough over distance without literally melting or losing the signal.
Wow. which forces the entire industry to shift to silicon photonics, which is, it's quite literally using lasers to transmit data as pulses of light between the chips.
Right, light instead of electricity.
But manufacturing a silicon photonics transceiver is not like soldering a copper wire.
Not at all.
You are aligning microscopic lasers with fiber optic strands at submicron tolerances in a mass production environment, all while making sure the components can survive the intense heat of an AI server rack.
It's insanely difficult to manufacture, and Jabil has positioned itself to manufacture these highly complex optical components at scale, which naturally commands a massive premium.
And that complexity extends to the thermal management of the racks themselves, right?
Oh, absolutely. You can't cool these new generation AI servers with traditional HVAC systems blowing cold air down an aisle.
The thermal density is just too high.
Way too high. You need direct-to-chip liquid cooling. This requires manufacturing server racks with integrated leak-proof plumbing, specialized coolants, and massive structural reinforcement.
Because a liquid-cooled rack is exponentially heavier than an air-cooled one?
Exactly. You're basically building a heavy-duty plumbing system inside a supercomputer. The engineering moat around manufacturing this infrastructure is widening rapidly, and Jabil is aggressively capturing that high-margin, high-complexity end of the market.
That engineering moat is clearly acting as a massive competitive advantage when it comes to customer acquisition, too.
For sure.
Because one of the most critical growth catalysts mentioned in this segment was Dastor's announcement that Jabil officially landed their third major hyperscale cloud customer in Q3.
That's a huge deal.
Just for context, when we talk about hyperscalers, we are talking about the apex predators of the tech ecosystem.
The absolute giants.
The Amazons, Microsofts, Googles, and Metas of the world. Entities deploying tens of billions of dollars to build data centers the size of small municipalities. Landing one of them is a company-defining event. Landing 3 validates your entire operational model.
And the mechanics of how they're acquiring these hyperscale customers is honestly a masterclass in enterprise sales strategy.
How so?
They utilize a very deliberate land and expand playbook. They don't just walk into a hyperscaler and aggressively bid to build the entire data center architecture from day one.
Right, that would be way too risky for the hyperscaler.
Exactly. Instead, they identify a specific, highly complex pain point. Maybe a specialized power distribution unit or a unique liquid cooling manifold.
They get their foot in the door.
They get their foot in the door by executing flawlessly on that single discrete capability. They prove their quality control, their global logistics competence, and their ability to scale rapidly.
And once you integrate yourself into a hyperscaler's supply chain and prove you can handle their volume without bottlenecks, the switching costs become prohibitive.
You're practically locked in.
Right. And Dastor noted they are running the exact same playbook with this newly acquired third hyperscaler that they used to secure their second.
Yes.
He laid out a very specific trajectory. For fiscal year 2027, this new customer might generate a couple $100 million in revenue. But he expects that relationship to rapidly expand, projecting it will cross the $1 billion threshold by fiscal 2028.
It is an incredibly sticky revenue stream. Once you are inside the tent, solving their physical bottlenecks, you naturally inherit more and more of the overarching infrastructure build.
Speaking of infrastructure bills, a significant portion of that expanding footprint revolves around power generation and management, right?
Absolutely, which was the strategic rationale behind Jabil's recent acquisition of Hanley.
Right, the Hanley acquisition.
Yeah.
Because you cannot discuss the scaling of AI compute without addressing the looming global power deficit.
You really can't. Hanley specializes in modular power distribution and energy systems. By bringing that capability in-house, Jabil immediately captured a critical double-digit margin business.
So they're no longer just assembling the server racks.
Right. They are providing the highly specialized modular infrastructure required to safely distribute megawatts of power to those liquid-cooled racks.
And what makes the Hanley acquisition particularly brilliant is the recurring revenue component.
Yes, the services side.
They are not just fabricating the power distribution units and walking away. Hanley brings a robust services division. They are installing, maintaining, and servicing this critical power infrastructure.
And when you have an AI data center consuming the energy equivalent of a mid-sized city, The maintenance of that power network is a non-negotiable operational expense.
Jabil just bought their way into a high-margin recurring revenue stream that scales linearly with the physical growth of their hyperscale customers.
It is a perfect encapsulation of their strategy to move up the value chain.
Okay, let me push back a bit. Play devil's advocate here.
Go for it.
AI is booming, obviously. We just spent 15 minutes talking about it. But Jabil makes a lot of other stuff. They are a massive, globally diversified manufacturing conglomerate.
They are.
Aren't global automotive and consumer markets totally stalled right now? Like, you'd think a manufacturer with deep roots in those sectors would be dragging a massive anchor right now.
You would logically assume that, yes. The daily financial news cycle is dominated by the softening of global consumer spending, extreme volatility in automotive sales, a big deceleration in EV adoption.
Right. So how did they not get crushed there?
Because the Q3 data contradicts that assumption completely. Their regulated industries segment, which houses their automotive, transportation, healthcare, and renewables businesses, actually managed to grow 4% year over year.
Wow. To what?
Hitting $3.2 billion. And that exceeded their own internal outlook.
So when the analyst community pressed management on how they achieved growth in the automotive sector despite the obvious global slowdown, what did they say?
Well, Dester provided a very nuanced breakdown of their competitive positioning. He readily acknowledged the demand volatility in the broader auto market, noting they are maintaining a highly cautious posture.
Sure, they aren't blind to it.
Right. But they are outperforming the macro environment due to three specific strategic anchors: accelerating export demand from their Chinese automotive partners, broad industry consolidation, and their heavy reliance on what he termed powertrain agnostic platforms.
Okay, that powertrain agnostic strategy is fascinating. It's the ultimate diversification hedge against consumer unpredictability.
It really is.
Like, if you are a legacy auto supplier whose entire business is built around manufacturing components exclusively for internal combustion engines, or conversely, if you went all in on manufacturing specific EV battery enclosures, you're at the mercy of volatile consumer preferences.
And government mandate shifts.
Right. But Jabil bypassed that risk entirely. They are manufacturing the advanced driver assistance systems, the LiDAR sensors, the complex infotainment displays, and the core processing units that vehicles require regardless of how they are propelled.
Exactly. They recognize that the modern vehicle is essentially just a high-performance computer on wheels.
Right. Whether you buy fully electric, a plug-in hybrid, or a highly advanced internal combustion vehicle, the underlying electronic architecture is fundamentally the same.
Jabil is capturing the secular growth of vehicle computerization while completely insulating themselves from the powertrain wars.
They're selling the software and the sensors to the entire grid, agnostic of the fuel source.
Speaking of the grid, the renewables portion of that regulated industries segment revealed a really fascinating macro trend too.
Oh, yeah. Because Dester noted their renewables business is seeing steady improvement, driven in part by traditional safe harbor projects, right?
Yes, but the real inflection point is a structural shift in demand.
Yeah.
They are seeing a pivot away from residential solar projects and toward massive commercial power generation, explicitly tied to AI data center infrastructure.
Boom. That is where Jabil's diversified model transitions from a defensive hedge into a closed-loop growth engine.
It's brilliant.
Their intelligent infrastructure segment is manufacturing the exact high-density servers that are currently stressing the global power grid.
Right.
And simultaneously, their renewables segment is capturing the contracts to build the commercial solar, wind, and energy storage infrastructure required to power those specific data centers.
The hyperscalers are demanding clean power to meet their ESG commitments while aggressively scaling their compute capabilities. And Jabil is positioned to manufacture both ends of that equation.
It is a beautifully constructed internal synergy.
It really is.
Now, to be totally thorough on the regulated industry segment, we do need to address the healthcare division. During the Q&A portion of the call, one of the analysts correctly identified a slight downward revision in the forward guidance for healthcare.
Yeah, and in a market this sensitive, any downward revision usually triggers alarm bells.
Should we be worried?
Not really. Dastor effectively neutralized that concern by providing the mathematical context. The downward adjustment was roughly $100 million on a multi-billion-dollar segment.
Okay.
As he pointed out, in the context of their daily global shipping volumes across the healthcare portfolio, that adjustment is virtually a statistical rounding error.
Right. And he reiterated that the fundamental thesis for their healthcare division remains entirely intact. Healthcare manufacturing is the definition of sticky revenue.
Oh, incredibly sticky.
The regulatory hurdles, the FDA approvals, the intense validation required for medical devices, it creates a product cycle that lasts for a decade or more.
Yes. Once a pharmaceutical or medical device company integrates you into their validated manufacturing process, the cost and risk of migrating to a competitor are just astronomically high.
And Destor highlighted specific secular growth vectors within that sticky portfolio. Jabil is heavily involved in the manufacturing of continuous glucose monitors and GLP-1 drug delivery devices.
Right, the weight loss injectables.
Exactly. The explosion in demand for those is driving massive volume requirements for high-precision sterile delivery mechanisms.
And to support that long-term volume, Jabil is actually bringing a state-of-the-art facility in Croatia online, targeting late fiscal 2027 or 2028. They are expanding capacity in anticipation of sustained, high-margin healthcare demand.
So if you synthesize the performance of the non-AI segments, the diversification strategy is functioning precisely as designed.
Perfectly as designed.
When consumer electronics face cyclical pressure, automotive exports and powertrain agnostic systems provide ballast. When residential solar softens, commercial AI-powered demands accelerate.
It's a natural hedge against economic cycles.
Even their third segment, connected living and digital commerce, which is usually highly sensitive to consumer spending pullbacks, managed a 5% growth rate, hitting $1.4 billion and beating conservative estimates.
It demonstrates a level of managerial competence that builds immense institutional trust.
Which is the perfect lens through which to view part 3 of our deep dive management guidance.
Because while the Q3 numbers establish trust, the guidance they issued for the remainder of fiscal 2026 and their preliminary look at fiscal 2027 demand serious scrutiny.
Yeah, they are projecting a scale of growth that strains the physical limits of global manufacturing.
They really are.
Let's unpack the raised full-year guidance for fiscal 2026 first. Jabil is now projecting $35 billion in total revenue. That's up from $34 billion.
Which, again, for a manufacturing conglomerate this size, to locate an incremental $1 billion in expected revenue deep into the fiscal year is staggering. It brings their expected year-over-year growth rate to roughly 17%.
But the absolute focal point of that $35 billion target is the underlying AI contribution.
Right.
Management increased their AI-specific revenue expectation to $13.6 billion for fiscal 2026.
A $500 million bump from previous estimates.
And up 50% from the $9 billion they did in fiscal 2025.
They are projecting the addition of $4.6 billion in net new AI revenue in a single 12-month period. That is a 50% year-over-year growth rate for that specific technological vertical.
And naturally, when you project 50% growth on a multi-billion-dollar base, the immediate question from the analyst community is about sustainability.
Of course. Are we looking at a one-time cyclical pull forward of demand or a structural multi-year ramp?
So how did Dastert address this? He gave a sneak peek at FY27, right?
He did. He offered a highly unusual sneak peek into fiscal 2027. While cautioning that official guidance won't be released until their investor briefing in September, he explicitly stated that they anticipate AI-related revenue to grow at a similar percentage rate in FY27.
A similar percentage rate, meaning another 50%.
The mathematical implications of that statement are profound.
That's staggering because it's growing off a much larger base now.
Exactly. If they achieve $13.6 billion in AI revenue in FY26 and they maintain a growth rate anywhere near 50% in FY27, you are looking at adding nearly $7 billion in new AI revenue the following year.
Pushing the AI segment alone past the $20 billion mark.
Scaling a business by 50% when the baseline is $9 billion requires exceptional execution. Scaling by 50% when the baseline is $13.6 billion requires a logistical and physical footprint expansion of historic proportions.
Which was exactly the line of questioning multiple analysts pursued. They wanted to know where the physical capacity is coming from.
Because you can't just manifest $7 billion in highly complex server racks in a parking lot.
No. You need specialized, climate-controlled, structurally reinforced factory floors.
Right. So Greg Hebert, the CFO, answered this by detailing their global footprint strategy. He confirmed they are actively adding an incremental 10% to their global physical capacity through new facility construction and massive expansions of existing sites.
And this expansion is highly strategic in its geographic distribution.
Dastor specifically pointed to major capacity coming online in North Carolina, Memphis, Mexico, and India.
Let's talk about the North Carolina facility because that's a prime example of their scaling speed.
It really is. It's currently in the ramp-up phase, and management expects that by January of calendar 2027, that single facility will be operating at a run rate between $1 billion and $3 billion annually.
They are effectively spinning up entirely new multi-billion-dollar manufacturing nodes across the globe in a matter of months.
But, expanding your physical footprint by 10% globally usually introduces a massive drag on profitability.
Right. Heavy startup costs.
You have to hire and train thousands of workers, calibrate highly sensitive machinery, run test yields before you can achieve commercial scale. Traditionally, that leads to a temporary but severe margin compression.
Yet, despite this massive capacity expansion, management is projecting core operating margins to push above 6% in fiscal 2027.
Dastor was incredibly deliberate in emphasizing the phrase 6% plus.
So what's the mechanism allowing them to expand margins while simultaneously expanding capacity?
It's a combination of product mix and systemic operational leverage. First, the intelligent infrastructure segment, which is driving the bulk of the growth, inherently carries higher margins due to the sheer complexity of the engineering required.
The liquid cooling, the silicon photonics we discussed earlier.
Exactly. Second, Jabil is anticipating a cyclical recovery in higher margin legacy markets, specifically wafer fabrication equipment, or WFE.
Let's expand on that WFE market because it is a critical piece of the margin story.
It really is.
Wafer fabrication equipment refers to the massive, ultra-precise machines used by semiconductor foundries to physically print the microchips onto silicon wafers.
Right.
The WFE market has been in a cyclical trough recently, but as the AI boom forces foundries to expand their capacity to meet GPU demand, the WFE market is poised for a violent rebound.
And Jabil manufactures subassemblies for these machines.
Yeah.
Because the engineering tolerances are basically atomic in scale, the margins are exceptional.
So you have the high-margin AI infrastructure growth compounding with a recovery in high-margin semiconductor capital equipment.
Plus, the integration of Hanley brings double-digit margin power services into the mix. And finally, you just have pure operational leverage.
Right.
As these massive new facilities in Mexico and North Carolina complete their validation phases and fill up with guaranteed hyperscaler orders, the utilization rates skyrocket. The fixed costs of the buildings are absorbed rapidly, and the incremental profit drops straight to the bottom line,
allowing them to confidently project that 6% plus margin for FY27. Now, while the North Carolina and Mexico expansions are driving the immediate FY27 capacity, the headline that generated the most gravitational pull during this earnings cycle was focused much further out.
Oh, the long-term India play.
Yes, geographically and temporally. Jabil announced they are targeting a strategic alliance with Adani Enterprises for a multi-gigawatt AI data center manufacturing platform in India.
Multi-gigawatt. When you attach that phrase to data center infrastructure, it completely redefines the scale of the conversation.
It forces you to think in terms of national utility grids rather than corporate IT budgets.
Exactly. Just to contextualize a gigawatt fee grid, a standard large-scale enterprise data center might draw anywhere from 20 to 50 megawatts of power.
Okay.
A single gigawatt is 1,000 megawatts.
Wow.
We're talking about the manufacturing infrastructure required to support the physical equivalent of multiple nuclear reactors dedicated entirely to artificial intelligence compute.
That's insane. And Adani is one of the most powerful infrastructure and energy conglomerates in India, right?
Yes. They control massive power generation assets, sprawling logistics networks, and vast tracts of industrial land. Jabil brings the proprietary world-class manufacturing expertise for next-generation liquid-cooled racks, optical networking, and high-density storage.
It is the ultimate convergence of power and precision. The strategic logic is undeniable. India possesses the world's largest population, a government aggressively incentivizing domestic manufacturing.
To position themselves as an alternative to China, yeah.
And an immense internal demand for localized AI compute power. But as investors, we have to maintain discipline regarding timeline.
We do. We have to temper expectations here. This is where management's credibility truly shined, honestly.
They didn't try to pump the stock by promising immediate revenue from the Adani alliance.
Not at all. Dastor was exceptionally disciplined in managing market expectations. He reiterated multiple times that this is currently a targeted strategic alliance. They do not yet have a definitive, finalized commercial framework or financial structure in place.
Right, translating the timeline, while huge, management was clear this is an FY 2028 event, not a tomorrow event.
He explicitly warned analysts against attempting to model this partnership into their immediate FY 26 or FY 27 forecasts.
That level of candor is exactly what you want from executive leadership. They are painting a massive, highly lucrative optionality play for the end of the decade, but keeping the market ruthlessly grounded in the near-term operational realities.
And speaking of near-term operational realities, if Jabil's going to hit that $13.6 billion AI target in FY 26 and grow it by another 50% in FY 27, they have to navigate a global supply chain that is currently stretched to its absolute limit.
During the Q&A, several analysts honed in on a risk of component shortages.
Yes, the specific choke points identified were high bandwidth memory, or HBM, and specialized interconnect printed circuit boards, or PCBs.
This represents the most significant immediate risk factor to Jabil's execution, doesn't it?
It does. It doesn't matter how efficient your factories are. If you cannot secure the HBM chips or the advanced circuit boards required to assemble the GPU clusters, you cannot ship the finished server racks.
And you do not recognize the revenue.
Exactly. Daysdor was transparent in acknowledging that lead times for these specific components are extending dramatically due to insatiable global demand.
However, he outlined two massive structural advantages Jabil utilizes to mitigate this risk.
Right. First is the sheer gravitational pull of their end customers.
Right, because when Jabil is procuring components, they aren't buying on behalf of a mid-tier enterprise.
They are buying on behalf of the largest hyperscalers on the planet. The vendors supplying the memory and the PCBs understand that Jabil's purchase orders represent the most critical infrastructure builds in the world.
That dynamic naturally secures Jabil preferential allocation and pushes them to the front of the fulfillment line.
The second advantage is the institutional muscle memory of their internal supply chain organization.
Battle-tested.
Very much so. Daster emphasized that Jabil's procurement conversations are no longer transactional or purely focused on unit pricing. They are engaged in deep strategic negotiations, securing long-term access and guaranteed allocations over multi-year horizons.
He specifically praised the team that successfully navigated the catastrophic supply chain disruptions of the COVID-19 pandemic.
Because an organization capable of managing the semiconductor shortages of 2021 is uniquely battle-tested to handle the AI component crunch of 2026.
Let me bring up one specific metric that emerged from this supply chain discussion because it is the one red flag waving on the balance sheet right now.
Okay, what is it?
Greg Hebert noted that Jabil's inventory days ended the quarter at 84. Even when you net out the inventory deposits provided by customers, the metric still sat at 68 days.
Yeah, that's high.
He openly admitted this is significantly above their normal targeted operational range of 55 to 60 days. In the contract manufacturing world, bloated inventory is terrifying.
It is.
Should investors be concerned that Jabil is suddenly sitting on a mountain of unsold, rapidly depreciating tech components because end demand is softening?
It is absolutely the correct metric to pressure test, but the operational context provided by management paints a very different picture than a demand shortfall.
Break that down.
Hebert explained that the elevated inventory levels were acutely tied to the precise timing of customer shipments within the intelligent infrastructure segment.
Timing.
Daster added critical color during the Q&A, revealing that they had a couple $100 million of fully finished goods sitting on the loading docks at the exact moment the quarter ended.
Which will immediately flow into Q4 revenue.
Exactly, which makes perfect sense when you understand the logistics of hyperscale data center deployments.
Because we are not talking about shipping pallets of smartphones to a retail store.
No, we are talking about coordinating the delivery of massive, liquid-cooled server racks to a data center construction site.
Right. If a hyperscaler experiences a one-week delay in pouring concrete or a slight delay in securing a final power permit from a local municipality, they cannot accept delivery of the racks.
So Jabil holds the finished product in their facility for an extra week, it crosses the quarterly reporting boundary, and it temporarily spikes the inventory days metric.
Given their $1 billion upgrade to the full-year revenue guide, they're clearly not worried about those finished goods becoming obsolete. They are simply waiting for the green light to put them on the trucks.
Exactly.
And this nuanced understanding of the operational reality brings us to part 4. The bottom line, it's the ultimate actionable question. So, what does this actually mean for someone holding or considering JBL?
My opinionated, highly bullish take is that when you synthesize the top line beats, the aggressive margin expansion, the staggering 50% AI growth rate, the global footprint expansion, and the resilience of their diversified model, you are presented with a highly compelling bull case.
But the real secret weapon, the fundamental metric that makes Jabil an exceptional de-risked investment in the current AI environment, is their capital efficiency. Right.
It's unparalleled. This is the crux of the entire thesis.
Okay, plain language translation. Let's look closely at their capital expenditures, or CapEx, because the numbers seem almost mathematically impossible compared to the rest of the tech sector.
They do.
Jabil is projecting the addition of roughly $5 billion in net new AI revenue this year, and potentially $7 billion next year. They are standing up multi-billion-dollar manufacturing nodes in North Carolina, Mexico, and India.
Right.
And yet, their projected CapEx, the actual cash they are required to spend on property, plant, and equipment, is staying flat at an incredibly low 1.5 to 2% of total revenue.
Barely anything.
Yeah.
To appreciate how extraordinary that is, you have to look at the broader industry.
Like the semiconductor foundries.
Yeah, they're spending tens of billions of dollars annually just to build the fabrication plants required to stay at the cutting edge of node sizes.
And the hyperscalers themselves are deploying capital expenditures that represent massive percentages of their total revenue just to secure the GPUs in the land.
Meanwhile, Jabil is facilitating this entire global infrastructure build-out while dedicating less than 2% of their revenue to capital expenditures.
So how does the financial physics of that actually work? How do you double your highly complex AI manufacturing footprint globally without burning billions of dollars in cash?
It all comes down to the underlying architecture of the contract manufacturing model. Jabil operates a ruthlessly asset-light framework. When they decide to expand capacity or build a new facility, it is almost never speculative.
They aren't just pouring concrete and hoping they can find a customer to buy the servers once the factory is finished.
No way. That capacity expansion is inextricably tied to visible, guaranteed, multi-year customer demand.
Oh, so the customers are funding it.
Basically. The hyperscalers are so desperate for this specialized physical infrastructure that they are often directly co-investing in the capacity. They are funding the specialized tooling, prepaying for the manufacturing lines, and providing massive inventory deposits to secure their place in the queue.
Wow. So Jabil is utilizing customer capital to fuel their own global expansion.
Yes, which radically insulates their balance sheet from the traditional risk of heavy manufacturing.
And the translation of that asset-light model for the retail investor is profound. Jabil assumes absolutely zero intellectual property risk.
Zero IP risk.
They are not spending billions of dollars on research and development attempting to design a neural processing unit that is 5% faster than NVIDIA's, only to have a competitor release something better next month, rendering their entire R&D budget worthless.
Or engaging in brutal software wars trying to build a better foundational model than OpenAI.
Right. They are completely agnostic to the outcome of the silicon and software wars.
If NVIDIA maintains its absolute dominance in the GPU market, Jabil builds the specialized racks to house them.
And if AMD or Intel manage to capture significant market share with their accelerators,
Jabil builds the racks. If the hyperscalers, Google, Amazon, Microsoft, successfully transition their workloads to their own custom-designed proprietary silicon, Jabil still builds the racks.
they are the toll collectors on the AI highway.
Perfectly positioned to capture reliable, expanding margins, regardless of which tech giant ultimately wins the existential battle for algorithmic supremacy.
They simply construct the physical reality based on guaranteed, pre-funded purchase orders, capturing the upside of the supercycle without the catastrophic downside risk of IP obsolescence.
And the most compelling aspect of this narrative is what they are doing with the immense free cash flow generated by this highly efficient model.
Right, let's look at the shareholder returns, the cherry on top. In Q3 alone, Jabil generated $359 million in adjusted free cash flow.
And based on the strength of the quarter and their forward visibility, they upgraded their full-year guidance to project more than $1.4 billion in free cash flow, up from their prior estimate of $1.3 billion.
And management is deploying that cash aggressively to the direct benefit of shareholders. During the third quarter, Jabil repurchased approximately $291 million of their own common stock.
They are currently operating under a massive $1 billion share repurchase authorization. And Greg Hebert was explicit in stating their intention to fully execute and complete that authorization in the fourth quarter.
Let's isolate that dynamic for a moment because it is the ultimate indicator of financial health.
It really is.
Here is a company growing their top-line revenue by 12%, expanding their core EPS by 24%, accelerating their multi-billion-dollar AI segment by 50% year over year, and funding a massive global footprint expansion.
All at the same time.
And yet their capital efficiency is so high that after funding all of that phenomenal growth, they still generate enough excess cash to buy back $1 billion of their own stock in a single year.
Systematically shrinking the float and increasing the ownership stake of every remaining shareholder.
It is a definitive masterclass in corporate capital allocation.
Furthermore, they're achieving this while maintaining a fortress balance sheet. They exit in Q3 with $1.4 billion in cash on hand, and their debt-to-core EBITDA ratio sits at a highly conservative 1.3 times.
Management is intensely committed to preserving their investment-grade credit profile,
which provides a massive shock absorber against unforeseen macroeconomic volatility, while simultaneously preserving their ability to execute strategic, margin-accretive acquisitions like the Hanley deal whenever the opportunity arises.
Okay, if we pull all of these data points together, the 12% revenue beat, the 24% EPS expansion, the explosive 50% AI infrastructure growth, the strategic acquisition of a third hyperscaler, the multi-gigawatt Adani alliance in India, and the unparalleled capital efficiency driving $1 billion share buyback, the Q3 2026 earnings report from Jabil is a fundamentally transformative document.
It forces a complete reevaluation of how the market values contract manufacturing in the era of artificial intelligence.
Because the market has historically assigned lower valuation multiples to contract manufacturers, viewing the sector as a commoditized, low-margin race to the bottom.
But the engineering required to manufacture thousands of liquid-cooled, silicon photonics-enabled server racks that consume megawatts of power is the exact opposite of commoditized.
It's highly specialized, moat-protected, mission-critical engineering.
And as Jabil continues to consistently demonstrate that they can sustain these expanding margins and generate billions in free cash flow, the market will inevitably be forced to re-rate the stock to reflect their position as the irreplaceable physical backbone of the AI industry.
It is a powerful reminder that while the broader market is obsessed with finding the next software breakthrough or the next revolutionary chip design, the reality of successful long-term investing often relies on understanding the mechanics of the supply chain.
Identifying the companies that are quietly, efficiently, and profitably turning a technological revolution into reliable, expanding free cash flow.
Thank you for joining us on this deep dive into Jabil's Q3 2026 earnings. We hope this granular exploration of the physical and financial realities of the AI infrastructure boom provides you with a more robust analytical framework for your own investment decisions.
Definitely.
Before you go, we want to leave you with one final provocative thought to analyze as you look at your portfolio. With the massive technology titans, Apple, Google, Microsoft, Meta, Amazon, currently deploying tens of billions of dollars in an absolute bloodbath over whose proprietary AI chip or foundation model will ultimately dictate the future of computing, is it possible that a contract manufacturer like Jabil, an entity that assumes zero intellectual property risk, refuses to pick favorites, and simply charges a highly profitable toll to engineer and build the physical infrastructure for whoever survives the war, is actually the safest, smartest, and most asymmetric long-term investment in the entire artificial intelligence sector? Keep pressure testing the consensus, keep diving into those actual transcripts, and we will see you on the next deep dive.